All right, how to buy a house in California with $0 out of pocket. What's up, guys? Welcome. And if you have been in the market to purchase your first home or looking to purchase in California, you know that it's been pretty freaking challenging here the last couple of years. And if you're looking in California, it gets even more challenging, and those challenges just kind of get multiplied by the general market in California with how competitive it is, with how prices and what prices are doing, what mortgage rates are doing, and it's pretty competitive. It's pretty crazy, and I can see some of the frustrations. If you don't know me, my name is George Morales. I'm a loan officer here in California, and I help first-time home buyers get into their first home. I try to demystify the home buying process as much as possible and really just break down some of the myths that might be out there when it comes to purchasing your first home. But today we're talking about how to buy a home with $0 out of pocket. I've talked about this quite a bit, and even on social, like some of the common pushback, I guess, that I would get when I say that I've helped many clients purchase their first home with $0 out of pocket is, one, they don't believe it's possible because of, everything we've heard over the last few years and how we've been conditioned to save 20% down and how competitive it's been and what rates are doing. But two, the other pushback that I get is that if it is possible, it has to be something that's, super cheap. And I'm going to show you guys in 3 simple steps today how to be able to go ahead and do that. I'll preface this with saying that as I go through this, I do want to just make it clear that when you are buying a home with $0 out of pocket, you're not buying, $1 million home generally. You're not buying a $2 million home. You're not buying something with 2 pools in your backyard. You're not buying something with a 4-car garage. If you are someone that's looking to purchase your first home and make a good amount of money, but maybe have had a hard time saving for down payment or closing costs and looking to use a strategy to get in your first home, just know that there is going to be some things that you're going to have to settle on. There's going to be some things that you're going to kind of have to sacrifice. And I hate using the word settle because it makes it seem like you're selling yourself short. But you have to understand that you just have to get your foot in the door, right? So the first thing is figure out what are some of your priorities in terms of what you want in the home, and also figure out whether you're going to be okay with settling on a few of those things, whether it be location, whether it be number of bedrooms, whether it be space, whether it's a single family home or condo. These are some decisions that you're going to have to make if you really just want to get your foot in the door with this particular strategy. So we'll get into it. And the first step to being able to do this is to get approved for an FHA loan. Now, you can do it with a conventional loan, you can do it with a VA loan, you can do it with all kinds of different programs. I'll talk about in step 3 why I would encourage an FHA loan. If you don't know what an FHA loan, it's a government-backed program by the Federal Housing Administration that allows you to purchase a home. You don't have to be a first-time home buyer, which is good news, but you do have to occupy the property as your primary residence, and they allow you to come in with as little as 3.5% down payment. Minimum credit score requirements for an FHA loan are going to be 580 or above. Generally, you want to be at 620, mid 6s or above, but the absolute minimum that they'll do is 580 or above if you're putting 3.5% down. If you have 10% down, then they'll allow you to go down to 500, but again, that's a different story for a different video, a different day. So an FHA loan with 3.5% down, you want to get approved for this. One of the cool things about FHA is that their debt to income ratio maximums are higher than a conventional loan program. So generally, when you're buying a home, lenders and banks want to see that your monthly debt payments, including the mortgage payment that you're going to have, as well as any other monthly debt payments such as car payments, credit card payments, student loans, personal loans, things along those lines, don't exceed more than 50% of your gross monthly income. With FHA, you can oftentimes go up to 55%, sometimes even 57%. So there's a little bit more generous or a little bit more favorable or easygoing guidelines when it comes to that. So step 1 is to get approved for an FHA loan. They'll allow as little as 3.5% down. The second part of this process is going to be to look into some first-time home buyer or down payment assistance programs that are going to help you cover your 3.5% down. So there's several different programs in California that you can look at out there. 2 of the ones that come to mind that I've helped many clients with is the Cal HFA My Home program. This program is a program that will help you cover that 3.5% or 3% down payment assistance. It's by the California Housing Finance Agency. And how this program works is, let's say you have an FHA loan and your minimum down payment required is 3.5% down. The state of California will help you cover that 3.5% down payment. It's not free money. They're giving it, or they're providing it to you as a loan with a 1% simple interest. And how that works is that when you sell or you choose to refinance the property is when that 3.5% down payment assistance that they provided will be due back to them. So if you are purchasing, let's just say, for example, a $500,000 home, 3.5% of that is going to be $17,500 that they'll provide. And then when you sell or refinance a home, let's say 10 years later, then you will have to give that assistance back out of your proceeds and at a 1% simple interest that they charge you. And the word simple in there is very important. It just means that interest doesn't compound over a month or day or year, whatever. It's just 1% simple per year, which means that you pay a lot less at the end of 5, 10, 15, 20 years whenever you end up paying that assistance back. So if you were to borrow, let's just say $17,500 because you're purchasing a $500,000 home and you're paying 1% a year in interest on that, that's $175 a year in interest that you're paying. So if you keep the home for 10 years and you sell it after 10 years, you'll have to give back that $17,500 assistance that they initially provided plus $1,750 in interest that you'll have to pay them back. So the second program that you might want to consider is a program called the GSFA Platinum Program. This is a program that provides assistance by the assistance provided by the Golden State Finance Authority, and they'll provide up to 5.5% in down payment assistance. Some cool things about this program is that you don't necessarily have to be a first-time home buyer, but you do have to occupy the property as a primary residence. No first-time home buyer requirement. If you use an FHA loan, there are no income limits behind this program, whereas with CalHFA, there are income limits. Now, the income limits are pretty generous for that first program that I talked about, but with this GSFA Platinum program, there are no income limits if you use an FHA loan. Up to 5.5% in assistance. The minimum credit score requirements are going to be 640 or above for this Platinum program, and the assistance, how it works is part of it is forgiven immediately at closing if you are in select occupations. So this is occupations like the medical field, if you're in law enforcement, if you are in the educational field like a teacher, things along those lines. There are certain occupations where they'll forgive part of that assistance immediately at closing. So as soon as you get your keys for your home, you'll be able to not have to pay part of that assistance back. The rest of the assistance is paid over a 15-year period of term, and it's paid at the same interest rate as your first rate mortgage. So let's say your mortgage rate on the FHA loan is 6.5%, just for example. The interest rates on the assistance that you do have to pay back will be the same rate over a 15-year period of time. So it can be a couple $100 more added to your monthly mortgage payment when you use a program like this one. So there are some pros and cons to both of them, and it's always good to compare each of them to figure out which one makes sense for you. Again, none of them are really free money. One of them, forgives some of the assistance immediately at closing, but the rest of the assistance you do have to pay back. So just something to go ahead and keep in mind. The third step in this strategy is find a way to cover your closing costs. And the way that we're going to do this is, so our down payment is covered, right? So because we are using FHA loan with 3.5% down, and because we are using either a CalHFA My Home program or the GSFA Platinum program, our down payment is covered. Now, anytime you use a down payment assistance program, you're generally going to have to pay some kind of origination fee or some kind of cost or charge that the lender is going to charge you to be able to help you with this down payment assistance program, because they essentially don't make a whole lot of money off of them. So the way that they make their money is via the origination charge, and that can be anywhere from like 1% to 2% of the loan amount, depending on different factors, but let's just call it 2%, right? So that is an origination charge that gets added to your closing costs. Now, this is separate from your standard closing costs. Closing costs generally consist of property taxes, titling, insurance, appraisal fees, things along those lines. There's several different things that are out there, notary fees, your credit report fees. There's several different things that are out there, but closing costs will generally add up to 2.5% of the purchase price. So we already took care of our down payment. Now we have to take care of our closing costs Plus, we also have to take care of this pesky, 2% origination fee that you'll have to pay in addition to that. So now how do we do that is obviously we want to buy with $0 out of pocket. So the way that we do this is we're going to negotiate for the seller to pay for our closing costs. So I would highly encourage you to use a real estate agent. And this is where having a good real estate agent or realtor is important because they're not all the same. I hate the saying, that's common in the industry where it's who you work with matters, because I feel like it's oversaid and not really the value of why choosing who you work with actually matters isn't demonstrated enough. But on the real estate side, having worked with several real estate agents out there, I can tell and I can definitely see the difference on the ones that are really out there going to bat for you, whether it's either getting a purchase price that's lower than what the seller wants, or two, which is a lot of times more beneficial, is negotiating a credit, especially, the last couple of years, is negotiating a credit from the seller to cover your closing costs. Now, what does a credit mean? A credit is really just the seller is giving you X amount of money from their proceeds to be able to allow you to use however you want. And you can generally use that to cover your closing costs, to buy down your interest rate, which is closing costs, or to buy out your private mortgage insurance if applicable, which is another form of a closing cost in a way. So we're going to want to negotiate this from the seller. Now, the reason why in step one I said get approved for an FHA loan is because there's limitations to how much we can negotiate and how much can be contributed from the seller to your purchase. With a conventional loan, the maximum that you can do is 3% of the purchase price. So if you buy a $500,000 home, that is going to be $15,000 maximum credit that the seller is going to give you if you put only 3% down, if you put the minimum down payment. Obviously, as you put more money down on a conventional loan, the amount of credit that you can negotiate from the seller increases. But if we're trying to buy with $0 out of pocket and we're a first-time home buyer and we have minimal funds that are available for a down payment, I can only imagine that if we were to use a conventional loan, we would only put 3% down. And if that's the case, then 3% is the maximum that you can get from the seller. And so the reason why I asked or why I suggested that you use an FHA loan is because FHA, regardless of your down payment, allows up to 6% in credits from the seller. So if you buy a $500,000 home, 6% of that is going to be $30,000. And the reason why we need the ability to negotiate this higher dollar amount is multifold. First one is that your closing costs can be anywhere from 2 to 2.5% of the purchase price as is. So we're already coming up on that 3% right away, right? But if you have an origination fee because you're using a down payment assistance program, that also has to be taken care of. And if you can't negotiate for that, then you might have to pay $10,000, $12,000, $15,000 or so total out of your pocket. And the goal here is to be able to buy with absolutely $0 out of pocket when it comes to your purchase price. Or when it comes to your home, rather. So if we can negotiate up to 6%, that allows us some wiggle room. So that's what we're going to do is we're going to ask your real estate agent to negotiate up to 6%. It doesn't have to be 6%, but all of your closing costs. So we're going to find out, ask your lender, what is your total standard closing cost? How much is your origination fee? How much would you have to negotiate from the seller to be able to purchase this home with $0 out of pocket, considering that the assistance program already covered our down payments? And so some of the things that you can run into and pushback that you can get on this is, hey, maybe the market is too competitive and there's 2, 3, 4, or 5 other buyers that are looking to purchase that same home and the seller is not willing to give you a credit. So a strategy behind this is, and why using an FHA loan is beautiful, is that connect with your lender and your loan officer and ask them to run the numbers on what it would look like. Let's say you're purchasing a $500,000 home, what it would look like to go to that seller, and if that seller wants $500,000 and that's what they want in their pocket, they're obviously not going to be willing to give you a credit back, because then that would cut into their net proceeds. But when it comes to this, you can increase your purchase price, let's say to $530,000, and ask the seller to give you a $30,000 credit back. And now they net $500,000, so they're happy because they got what they wanted, but you also have $30,000 to play with now. Chances are your closing costs and your origination fee are not going to be $30,000, but you'll have extra money to go ahead and play with to either buy down your interest rate. So if your absolute maximum pre-approval was at $500,000 for your purchase price, then you usually can't do that, right? You can't buy a home for $530,000. But if you're getting that large of a credit back, your loan officer can run the numbers to figure out how he can use that money to, one, cover your closing costs and the origination fee, but two, make sure that you're qualifying for that higher dollar amount by applying the overage, the rest of the credit, towards buying down your interest rate. Or maybe you just have extra credit that you can apply towards buying down your interest rate to make your monthly payment more comfortable. Maybe you can already increase the purchase price without having a qualification issue when it comes to debt to income ratios, and you just have extra credit to get a better payment, a better rate, etc., so you don't have to refinance so quickly as interest rates come down here over the next couple of years. So first step, get approved for an FHA loan. Two is get approved or look into a down payment assistance program and work with a lender or loan officer that is familiar with these programs, because they can be tricky if you aren't familiar with them. And then number three is to be able to negotiate, ask your realtor to negotiate a credit to cover all of your closing costs. So hopefully this is helpful for you guys. Home ownership is possible. Don't let anyone tell you that you can't. Just connect with a good realtor and a good lender that are going to be able to be strategic about your particular scenario to get you in a home. Have a good day, guys.